What's happening, guys? Welcome back to another episode of Real Estate with Gav, and where the topics are always about real estate, finance, and community. And today I got a special guest with me today, Mr. Steve Dopson with Dopson Associates. How you doing today, sir?
Doing great, Gavin. It's good to see you again.
Yes, sir, always. For those of you that don't know, Uncle Steve, as I like to call him, and we go way back. So one of his youngest sons and our best friends from long time growing up. So Steve even used to coach me in sports back in the day. One of my mentors. So I always look up to Uncle Steve, and so this will be a good, fun family podcast for us. So, but tell us a little bit about yourself and what you do.
Okay, so it's good to be here, Gavin.
Yes,
it's
sir.
Great to see the things you're doing, and this is a great format for getting information out to people.
I appreciate that.
Most of my background, I'm a CPA. Of course, I've been a CPA for I won't say how many years because that dates me, but most of my background has been as a controller or CFO for some small and medium-sized companies in the area. I've been in this area my whole life. I grew up in Jefferson County, moved to Berkeley County after I got out of college, and have been here ever since. Like I said, worked with a lot of high-growth small businesses, so familiar with all the growing pains that goes along with that.
Right.
And I'm about 15 years ago or so, I started having this inkling that I needed to put this experience to use for other small businesses that maybe can't afford a CFO and a chief operating officer all those things. So, decided to go on my own, and have been doing that ever since. So,
awesome.
Have married to Julie, as you know, and
Yes,
have
sir.
3 great kids who are all grown and gone now, self-sufficient,
Yep.
and not on my payroll anymore. So that's a nice thing.
Awesome. Good to know. Good to know. So what we're going to talk about mostly today is taxes. We got our special CPA here. He helps me with my taxes pretty often. So I thought you'd be a great person to come on and kind of break down some things that people may or may not know about taxes. So just starting off, tell us a little bit about how taxes differ for a self-employed person versus a regular employee.
Well, probably I could preface every question you're going to ask me with, it depends.
Of course. Everything's a little
Because,
different.
nobody should take this as specific tax advice to your situation. Because
Right.
every situation is a little different. So we'll probably be speaking in generalities. This
Right.
is generally the case.
Yes.
But for a small business owner versus an employee,
Right.
so one of the biggest changes that happens is you no longer have withholding unless you're paying yourself a salary from the business. And that's a big adjustment for people, because now you have to be more conscientious about your tax payments, your estimated payments and those things,
Right.
to make sure you don't owe a big chunk at the end of the year. And I mean, a lot of small people go into business and they start getting all this cash going in, and they just start spending it, thinking, oh, well, this is my net cash, I can spend it, and not taking into account the taxes.
Right.
But one of the biggest differences is, if you look at your withholding pay stub, on your pay stub, you'll see there's federal tax withheld, there's Social Security withheld,
Right.
and state taxes. Well, what you don't see is that the employer's matching your Social Security and paying that to the government. So it's 7.65% comes out of your check. Employer pays that same amount to the federal government, to your Social Security fund. So, when you're self-employed, especially when you're a sole proprietor and including that on your personal tax return, you're paying both halves of that. There's a thing called the self-employment tax.
Okay.
So a lot of people don't realize that, and if you're in a 25% bracket, you're paying 15% Social Security plus 5% state. You could actually be paying 40% of your net profits to taxes.
Wow.
And it's very important to do some planning and figure out ways to minimize those things. So
yeah, very important, very important. Now, depending on the business, I know, like you said, we're speaking in generalities here. So, just like on a general term, how much would you kind of encourage a small business or a self-employed person to like plan? Like, okay, I need to take this much or this percentage out of each check and set aside for taxes.
well, it depends.
I know. It definitely depends.
So but prior to the last large tax act that was passed in the 2018-2019 era, corporations had a much higher tax rate. So almost always it was better to get as much income on your personal return as you could. But now the top corporate rate's 21%, and that's a flat rate, and no matter how much you make. And then state tax is around 5 to 6%, depending on the state you're in.
Okay.
So you're talking 26%. Well, your personal tax can be a little higher, depending on if you're married, if your spouse works. Because what happens is when that business income goes to your personal return, it all gets lumped together. So some people confuse business with corporation. Corporation is a taxable entity where a business can be a corporation, but a business can also be a partnership, a sole proprietorship, any of those things. So as a general rule, I would say if you're a corporation, if you save about 30% of your net profits, now that's not gross income coming in because every business has a different expense structure.
Right.
Some have none at all. Some have tons of expenses and only 5% goes to the bottom line. So of the net expenses, about 30%.
Okay.
With individuals, because of all the deductions you get, it can be as low as 25.
Okay.
But as we just talked about, if your spouse is working and all that income you're making is going on top of that, it could be as much as 40% you need to save. So
good to know. Good to know. So as a individual person or a business, typically you have to pay your own taxes yourself.
Correct.
Now, how often should you be doing that?
So it's mandated by law that you need to pay quarterly estimated taxes.
Okay.
And that's for a business, or if you're just an individual and you have a bunch of interest income or capital gains every year or things like that, if you're going to owe tax in addition to what's being withheld from your checks, you need to pay quarterly estimated taxes.
Okay.
Now the quarters change a little bit, whether it's a corporation or just your personal return.
Right.
But basically it's, in April, June, September, December range that you need to pay those. And there can be penalties if you don't.
That was going to be my next question. Is there any penalties for people that wait too long to pay taxes?
So basically what the IRS charges you will penalize you with is there's a thing called the federal standard rate.
Okay.
So there's like an interest rate that's built, and it's pretty low, but then they tack on an extra 3%.
Okay.
So that can be, you can be penalized with that. But the big penalties come if you don't file your return on time or pay the amount due by the due date.
Okay.
Each of those can have a 5% penalty per month, up to 25%.
Wow.
So if you don't file on time and you don't pay on time, you could be looking at a 50% increase in your tax liability.
Okay.
So,
all right. So make sure you pay on time.
Well, and definitely file on time, even if you can't pay.
Right.
Get yourself in the system, and a lot of people that come to us after the fact have not done either because they're just afraid the IRS is going to come shut their business down.
Right.
So, but make sure you file even if you can't pay.
Gotcha. Good to know. So one of the main tax advantages as a self-employed person or a business owner that I've learned is that you get to deduct some of your expenses. So what are some of the regular expenses that businesses are able to deduct?
Yeah. Well, generally it's anything it takes to run your business. So if you're incurring an expense solely because you have a business, it's probably going to be deductible.
Okay.
I mean, if you're renting office space, the rent, the utilities, the phones. You can deduct your cell phones in certain cases. You know, and one of the things that's often misunderstood, because there's so many conflicting rules the last few years, is meals.
Okay.
You know, if you're going out to a business lunch,
Right.
I mean, you can deduct 50% of that.
Okay.
Now that was suspended during COVID, but that just expired in 2023. That you could deduct 100% of those.
Okay.
But now it's reverted back to 50%.
Gotcha.
But the thing is, you need to determine if you're doing a meal like, say, a Christmas party or a whole staff lunch, and then everybody's invited, you can get 100% of those.
Okay. Okay.
So it's one of those things. It depends.
It depends. Yep. No, I'm with you on that. I got you.
And don't forget about your home office. There's a lot of reasons for establishing a home office.
Gotcha.
Even if you have a fixed business location.
Okay.
Because, you know, I'm sure we'll probably talk about vehicles at some point.
Right.
But basically, community mileage is not deductible. So you driving back and forth to work is not a business expense.
Right.
But if you have a home office established, then the first place you go every day becomes deductible. So even if you only have a home office, you know, especially if you only have a home office, you need to establish that, even if you don't think you want to take the chance on putting those things on your return.
Yeah.
Because if you don't, then the first place you ever go every day is commuting.
Right.
So if you don't have that home office, the first place you go is commuting, not deductible.
Got you. That's super smart. Because I actually was going to tie into my next question about home offices. What are some things that people should include in their home office that they can also write off? I know you mentioned about the travel from your home office. Can you also deduct, you know, maybe utilities or you know, computer or furniture stuff you use in your office?
Yep, absolutely.
Okay.
Absolutely. Now, you can't deduct all of it.
Right.
But the IRS rules are that you have to use a specific area exclusively for the business purpose.
Right.
So basically, you take the square footage of that area, divide by the total square footage, and then all utilities by that percentage.
Gotcha.
Now there's but the utilities you include is electric, internet. Okay. They can't include your cable TV in that unless you're using it for the business purpose. If you're a stockbroker and you're following stock trades all day and you keep that on the screen, we can consider that.
Okay.
But there's also a simplified method that's kind of like a safe harbor that the IRS gives you, that you can deduct $5 per square foot of the office space used.
Okay.
So that's kind of a simplified way that you don't have to track all those expenses. But, you know, when you're considering, you can include your mortgage interest as part of that, deduct the rest on your Schedule A. You can depreciate part of your home. That's a small deduction, but it all adds up over time.
It does, for sure. No, certainly. Now, you mentioned a minute ago about vehicles. And as a realtor myself, I use my car for work all the time, and I know a lot of other, you know, business owners use their car. So what are some things you can include, or how can you write off your car usage?
Right. So there's two ways you can go. Well, there's actually more than two ways, because you can have your company own the vehicle. That's one way.
Okay.
And then, of course, you have to, then if you're also using the vehicle for personal use, you have to take part of that into your income.
Right.
But if you're using your personal vehicle that you own personally for the business, there's two ways you can go. And you can use the actual expense method, which you can include your gas, insurance, property taxes, all those things that go around your vehicle, and you take a percentage of it based on the business use.
Okay.
Now, if it's over a certain percentage, then you can also take some depreciation on the vehicle.
Okay.
The catch there is, you sell the vehicle, you got part of capital gain on that vehicle because you've deducted it as a business expense. The easiest way is just to use the standard mileage rate and track your miles. And there's a lot of apps out there now that you can track your mileage. You swipe left for personal, right for business, and that's probably the simplest way.
Okay.
Again, going back to the commuting issue, what a lot of people don't understand is driving back and forth to work is not a business expense.
Right.
So, and the IRS will catch you on that.
Gotcha.
They love to find those things.
Yeah, for sure. Now, are there any business expenses that you can think of that are good, actual good write-offs that some business owners just don't know about or that they forget? Like for me personally, like when I first got started in real estate, like I was like, oh, I didn't know I could include my cell phone or a cell phone bill because I use
Right.
it for business.
Right.
So anything like that?
Right. Yeah. There are. That's one that's often overlooked. Of course, we talked about the home office. That's another one it's just mandatory you establish that.
Yeah, yeah.
Even no matter if you I mean, well, you definitely want to be using it,
Right.
but you really need to establish that home office expense. But one thing I've found that people do is just like the small cash expenses you might spend on a day-to-day basis. Like you pay cash for meal, you save the receipt, and then you forget about it.
Right.
There's a bunch of apps for that too, where you
Yep.
can take pictures of the receipts and save them.
Yeah, that's what
But
I do.
that's a huge one. A lot of times when you're starting up a business, people forget about those costs. But those startup costs can be a great source of deductions for you. And no matter how big or small the deduction is, getting yourself in that mindset
Yeah.
of thinking about everything you spend. Is this something I can deduct?
Right.
Because what did we talk about before? Up to 45% could be taxed.
Mm-hmm.
So if you're spending $10, it only costs you $5.50 if you're paying 45% tax because you're saving that tax benefit. And of course, the one we harp on all the time is retirement plan contributions because there's just talk about a complicated area. There are so many different ways you can put money away for retirement. And again, it depends,
Of course,
which method is which course is best for you.
Gotcha. Yeah, I got a couple questions about that here shortly. I kind of want to get into that as well.
Yep.
Before we jump on that though, what are some major life events such as like getting married, having a kid?
Right.
Some people go through divorce. Like, how do those impact your taxes?
Yeah. Well, all of those areas are just such emotional times for people, especially divorce. I find is one that the last thing you're thinking about is tax ramifications,
Right.
And that's rightly so. But the thing you have to consider is, especially with a divorce, you've been filing married, you've been having your withholdings come out as a married couple. Now you're single. You're going to file single this year. If you forget to change your withholding, you can end up with a huge tax burden at the end of the year because the brackets change for single people. And the same thing when you're married.
Yeah.
When you get married, you should look at your withholding too because you've been having a lot withheld that you may not need to withhold anymore.
Right.
And so what's better that you have that money month to month so you can pay extra on your mortgage or put money into a retirement plan or fix up your new house you just bought when you got married. So there's a lot of things there that you need to consider. I mean, it's again, marriage and divorce especially, that's not going to be at the top of your list.
Of course.
But it's definitely something you need to plan for. One thing that can happen, especially if your spouses you're in a partnership with your spouse, is if you're separating, one person's going out of that partnership, it can trigger a dissolution of the partnership. And that can have all kinds of ramifications, capital gains, just it can really put a tax burden on you.
How about having kids?
Oh, kids are great, right?
How's
Well,
that
and you used to get a thing called a dependency exemption.
Okay.
That's kind of been converted into a $2,000 tax credit, which is better for you because it went from a deduction from your taxable income to an actual credit off your tax.
Nice.
And of course, you have kids.
I got two. Yep.
$2,000 a year is more than enough to pay for the cost of having a kid, right?
Not even close. Not even close.
But it helps.
It helps. Yeah, I'll take it, but I could use a little bit more.
So yeah, you get that deduction up until your kids turn 17, and that's a great time to have that. And after that, it reduces to $500. One of the things people often overlook is that if you're caring for your elderly parents or you have a special needs sibling or somebody like that you're caring for, that can be a dependency exemption for you as well.
Okay, good to know.
And you can get the $500 credit there too.
Sweet.
One thing that I think gets missed is once that credit goes away, drops to the $500 when your kids get older, people think, well, I want to keep claiming them because I get in this big tax deduction. But sometimes it can be better, especially if the child is working,
Okay.
for them to claim themselves and you not to claim them when you look at the overall combined tax benefit of both. And I have parents that are always working deals with their kids on, hey, let me claim you and I'll give you half the benefit, or things like that. But it's a real it's something that you need to look at.
Gotcha. So you touched on this a minute ago about retirement contributions. Talk a little bit about how that has some tax advantages, specifically
Right.
things like a 401k or an IRA.
Right. So the real benefit, the benefit of the tax of a tax deferred
Right.
plan, and I say deferred because it's not a tax-free plan.
Exactly.
You're deferring the tax until you retire.
Yeah.
So there's two benefits of those, and that is you get a current tax deduction. So that means like if you're making $50,000 a year and putting $5,000 into an IRA or 401k, that comes right off your income. So you're only going to report $45,000 to the IRS. So you've saved $5,000 times whatever that rate is for you. Say it's 30%, you've saved what, $1,500, right? Right off the bat.
There you go.
Now the next benefit you get is all that income's going to keep accumulating without any tax. So if you had that in just a private investment fund in your name, you're going to be paying that 30% tax on that every year.
Right.
So that's going to be less and less that stays in that fund. So when it's in a retirement account, it's growing tax free.
Okay.
Now with a standard retirement account, such as like a 401k or IRA, that money comes out, it's taxable.
Right.
But the goal is you're going to be in a lower tax bracket when you retire. So you're going to put money in at that 30% rate, but when you take it out, you're going to be in a 15% bracket.
Okay.
So you're saving there as well.
Okay.
One of the best things to come along, especially if you're younger, in the last 10 or 15 years, is the Roth IRA. Because now with a Roth, you are not getting a tax deduction when you put it in.
Right.
But that money accumulates tax-free, and when you take it out, none of it is taxable. Now, we've been saying in the profession for years, they're going to find a way to get that money someday. They're going to find a way to get their taxes off that money.
Yeah.
But so far, it's so good. I mean, and once you hit 59.5, you could take it all out, or you could let it keep accumulating.
Okay.
There, so.
Talk a little bit about the SEP IRA. That's something that I recently set up as a
Right.
self-employed person.
Right.
I believe business owners can also set that up.
Yep.
It's it has some tax advantages as well. How does that
Yes.
differ from like a regular IRA?
Yeah. So a regular IRA, you're limited to about $7,000 you can get per year.
Okay.
You can get more than that if you're over 50. You
Okay.
get like what's called a catch-up contribution.
Okay.
With the SEP, you can contribute up to 25% of your net business income to that account, up to $63,000. So
Okay.
if you're making $500,000, you're not going to get 25%. You're going
Right.
to get 63.
63.
But that's a huge benefit. Plus, you can put it in up to the due date of your return, including extensions. So let's say for tax year 2023, you want to make a SEP contribution of 25%. Well, if you extend your tax return from April 15th to October 15th,
Okay.
you have until October 15th to come up with that money and take it on your last year's return.
Wow.
And that's a huge benefit because
Yeah.
a lot of people, you don't know what your business is going to be like throughout the year, and you don't want to commit to putting that in every week.
Gotcha.
And then find out you can't deduct it and you got to take it back out.
Right.
So that's a big benefit, and I encourage people to file extension even if you're not going to file late, because that way it opens it up. If the IRS comes back and finds something in your return, you can amend your return, take the SEP contribution, and you're still good up through October 15th. So
nice.
plus it gives you the extra time to come up with the money.
Nice. Yeah,
Yeah.
very good. Very good. So,
But now the thing is, a SEP, you can't discriminate. So if you have employees, you have to do the same percentage for everybody.
Gotcha.
That meets a certain criteria, and you can set that in your plan. So.
Okay, good to know. So based on what I'm hearing, so now it's 2024. If I haven't filed my taxes yet for 2023, I can go back now and start adding contributions for the 2023 tax year.
Right. And you can also do that with your IRA.
Oh, good.
With your personal IRA.
Okay.
Now, if you're in a 401k plan, that's pretty much done.
Right, yeah.
But the employer can put in more. So if you are the employer, you can put in more to the 401k after the fact, but
gotcha.
And still get that prior tax year deduction. But again, there you're doing it for everybody.
Gotcha.
So.
Makes sense. All right, let's talk about a couple little tips and tricks that you can throw into your business or tax plan strategy. Is it true that you can pay one of your kids to kind of work in your business and get a tax deduction?
It absolutely is.
Okay, how's that work?
And so now you don't want to. It's got to be an age appropriate job, so you don't want to hire your 2-year-old to do your accounting.
Right.
Although I think yours probably could, or he would give it a
yeoman's
effort.
Yeah, he's 7. He'd give it a try for sure.
But so it's got to kind of match, and it has to be a reasonable wage. So you're not going to pay your child $50 an hour to empty the garbage.
Right.
But the benefit is if they're under 18, you don't have to pay the FICA tax on them or the federal unemployment tax, which it's small, but it adds up. Mm-hmm. So you don't have to pay those. But the other thing is, if you make them a W-2 employee, they're going to be able to make up to $13,750 and not pay any tax at all.
Okay.
So you're getting a deduction, you're getting a job done by your kid.
Yeah. And
they're not paying any tax on it because they get a standard deduction when they file their return.
Wow. Okay.
So that's a huge benefit.
That is.
It again needs to be age appropriate.
Right.
And not just a fake job.
Okay.
Because you don't want the IRS come in and say, well, we'd like to interview your son,
Yep.
Mr. Washington, and see if he actually
knocking.
knows how to do your marketing on Facebook.
Yep, they'll come knocking. They'll come knocking for sure.
And actually, marketing is a great way to use them because, let's face it, most of our kids are going to know a lot more about social media and how to market our businesses than we do.
True. Cool. Tying into that a little bit, are rental properties a good investment, and how does that help your taxes?
So the last few years, I've become convinced that everybody should own a rental property.
Okay.
Or try to somehow, even if you have to go in with several other people to do it. Because basically what happens if you have a rental property, let's say you have a mortgage of $1,000 on the rental property.
Okay.
And you're collecting $1,700 in rent income per month.
Okay.
So that's pretty standard, I think, in the area. That's probably low right now with if you've got more than a couple bedrooms, because everybody's renting right now.
Yeah.
So who's paying your mortgage?
The tenant.
The tenant's paying your mortgage, right? You're putting nothing out month to month. What's happening to that mortgage?
Paying it down.
It's going down. Yeah. So you're building equity in the property. What is happening to the property around here? It's going up.
Going up in value.
So you're building equity in that property on two sides, and you're not putting out a dime to do it. And that is like one of the biggest benefits of having a rental property. The other thing is it brings in a whole bunch of expenses like mileage and taxes that all of a sudden are deductible from that. So, and you can depreciate the property as well. And what happens in a lot of cases is you end up breaking even or even maybe having a small loss on the rental property on your tax return, which is a benefit, comes off all your other income. But at the same time, you're building wealth and equity in that property. Now, there are a lot of headaches that come along with owning a rental property.
Of course.
And you got to be willing to deal with that. But there are also a bunch of management companies around now because there's so many rentals that will take care of all those headaches for you for a small fee. And again, that fee's deductible.
Of course.
So, and to actually tie it in a little bit to what we were talking about before with hiring your kids.
Yeah.
Let's say you got kids that are going away to college and you know where they're going to college. Or maybe you don't know. So, but let's say they're all going WVU.
Okay.
You know, you got the first kid going. You buy a property in Morgantown and you get your son or daughter and some of their friends as your renters. Again, you're getting all those benefits. You're building equity. You're paying down your mortgage. But the additional benefit is you can pay your child to manage that for you.
Okay.
To like take care of all the utility stuff,
Right.
to take care of tenant issues, to
Yeah.
take care of all that stuff. So you're giving your child spending money and deducting it on your return, because who's not going to give your child spending money? I've had 3 in college, and I know you're sending money you should have ATM buttons on your chest to send that money.
Yeah.
So
for sure.
that's a great way. And then at the end of that, if you want to stay in the rental business, you can sell that property, do what's called a 1031 exchange, exchange it for a property maybe more local. If you don't want to deal with a bunch of college kids that you don't know
Right.
renting your place, and have a rental property there.
Wow.
And basically what happens with the 1031 exchange is any gain you would have on selling that property, you roll into the new property and you defer that until you sell the new property.
Gotcha.
So it's a great vehicle. And I tell you, if you can figure out a way to buy a rental property, you should do it.
That's one of my goals. I'm
Yeah.
gonna get there.
Yeah.
With the rental property, real quick, because I get this question a lot. I work with investors that buy rental properties. When you get rental income, do you have to pay taxes on the rental income? Like if you make a profit?
If you make a profit,
Yeah.
yes, you do.
Okay, gotcha.
And it's very hairy, and you need to have an expert on the front end of buying that.
Okay.
Because of how you set it up. Because there's certain tax vehicles you don't want to be, like an S corporation. You don't want a rental property in an S corporation.
Okay.
Partnerships are okay. Corporations can be okay.
Okay.
Regular C corporation, we call them. But the other thing is, I encourage clients to put their rental properties into separate LLCs.
Okay.
Because let's say you have 10 rental properties and you have them all in one LLC. What happens? You have a fire at one rental property, and somebody gets hurt or dies.
Right.
They're going to sue you. They're going to take all those properties.
10,
If
yeah.
it's your fault, all those properties are gone.
Good to know.
So you can silo them into separate. Now, I do have clients that like put a few in one.
Right.
And it's a little more complicated, and you do have to file additional returns. But
Okay.
the benefits and the protection is,
No, that's good to know because I didn't think about that.
definitely a huge benefit versus the cost of something going wrong.
Right. So in your example that you use with the, let's say you're renting it out for $1,700, but your mortgage is only $1,000, you would still need to pay taxes on that $700 gain.
Well, it depends.
Always does.
So you're not going to get to deduct the whole $1,000 mortgage.
Okay.
You're going to get to deduct the interest on that.
Okay.
Now, typically the depreciation on the property, because and that's where it comes in key to separating out your appliances and things, because they have a
Right.
faster depreciation
Okay.
life versus the building itself, which has a longer depreciation life. So you'll get to deduct that depreciation, and that doesn't cost you anything. That cost has already been incorporated into the purchase price.
Gotcha.
So that's like a non-cash expense that you get to deduct.
Okay.
Now, so let's say it only comes out to $500 of depreciation versus say $600 of the principal you're paying on your mortgage.
Right.
So you're going to get the $500 deductible, not the amount principal you're paying.
Okay.
So you do have to base your rent off of what your cash flow is going to be.
Okay.
Not really what your tax liability is going to be.
That makes sense. Makes sense. So we've talked a lot about, the different tax strategies and planning that goes into it. How important is tax planning ahead of time, and how often should you be doing it?
Yeah. So there's a saying that's kind of stuck with me. I heard it a long, long time ago, and it's, if you don't know where you're going, any road will get you there. And so we like to say plan, 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 and we like to look at next year when we're doing the prior year's return. So before April 15th, we'll question our clients. What's coming up? Any big changes? Is your market down? Is it up? What's your cost of employees? What's happening?
Okay.
And typically the first estimated payment we'll just base on the prior year return.
Right.
Unless there's something major happening. But the next payment's going to be due in mid-June. So we like to get with clients around after May ends, so that we can. It's a small window of 15 days,
right,
to do some planning there. But that way we say, okay, do we need to make an adjustment now?
Okay.
But definitely in the last quarter of the year, we will get with our clients and say, okay, what's it been like? What's going on? Do we need to increase our last estimated payment, or do we need to decrease it?
Okay.
Or can we decrease it, or maybe not make it at all if it's been a bad year? So it definitely is, the last thing we want are surprises.
Right.
Because even though we're just the messenger,
yeah,
we're going to get the blame.
Of course. Yeah.
And that's fine. We're willing to take that.
Yeah.
But yeah, planning is key.
Cool.
To all of that, and and things change throughout the year. Like you said, kids come, you might get married, whatever. There can be changes during the year that you need to look at.
Gotcha. So you should really be meeting this year to plan for next year.
Right, and really any even a change in job, if you're a W-2 employee, can wreak havoc on your taxes, because since the new withholding schedules came into play a few years ago, we have had so many more people that owe tax at the end of the year.
Right. Because
it was designed to give you more of that money up front. So if you have a big increase in salary by moving to a new job, and you've been withholding half the year at this old salary that was lower,
right,
you could be in trouble, because all that old salary is going to go on top of your new salary when you file your taxes.
Gotcha. So. Nope, those are definitely good things to know. So as a business owner, most people you see during tax time, they're getting refunds and things back. And a lot of people get excited for that, and rightfully so. As a business owner, do you want to get a refund back, or do you want to try to keep it low as possible?
Well, the ideal would be zero. Your return comes out to zero. We very seldom have that.
Right.
I've had it in single digits, but that's about as close as I've ever gotten.
Okay.
Because what do you want? You want your money sitting with the IRS all year.
Yep.
And when you need money to run your business, or your kids need shoes, or whatever the case may be, or do you want that? And there are ways. If you want a savings account, a tax refund's the worst way to do it.
Right.
So, again, the planning. Now, you don't want to owe either. So,
yeah,
you need to be very careful about that. It's nothing wrong with having a little cushion.
Yeah.
That so you don't owe and get into all those penalties that we talked about. But again, the ideal is to be as close to zero as you can. And with the changes in those withholding tables that I referenced before, it's just been a new world, even for people who don't have a business the last few years.
No, definitely good. So if you do get a tax refund, say you are getting a large tax refund back, what are some good things you could do with your tax refund other than go shopping?
Well, I'm a believer in Jesus Christ.
Yes, sir.
And that's been a big part of my life.
Yes, sir.
So I'll just tell you what I do.
Okay.
When I get a chunk of money that I didn't know was coming,
I
immediately give 10% to my church
to
do that work, because I figure if somebody's willing to die for me, the least I can do is pay a little back.
Amen.
So that somebody else hears that message. So 10% give away, 10% blow it.
There you go.
Buy something you've wanted, and even if it sits in your closet all year, just get that out of your system. Buy it. Just take 10% and blow it.
Gotta have a little fun.
Yep. And then the rest, figure out how to invest it. And it can be maybe an investment as part of a rental property partnership. It can be maybe you start funding next year's IRA.
Okay.
That's a great thing to do with it.
Yep.
Or maybe just set up an investment account that, you're going to start in a mutual fund
There you
company. With a mutual fund, you can buy a whole basket of stocks. You don't have to be subject to just one stock failing,
Right.
and a professional is actually managing that.
Yep.
So
Yep.
that's been my kind of MO on those, getting a chunk of money, and it's give
like
10, blow 10, and figure out a way to make the rest work for you.
I like it. Now, you've been active in the community for a long time. As I mentioned, when I was a kid, you were coaching sports. I know you're active in the church and everything now, and maybe even recently. I think I heard you got into a new position. So just talk a little bit about things you've done in the community and things you're doing right now.
Yep. Well, I am a pastor at my local church.
Nice.
I'm one of several. I'm not the regular Sunday morning preaching pastor, but I've led worship. I've been involved in teaching. So I've done that. My wife and I, kind of sharing that ministry together, and it's been a great partnership for us.
Cool.
My wife and I are as different as night and day, but we complement each other.
Yeah,
and
that's what it's about.
That's just been an amazing relationship for us, and a great journey.
Good.
I've been a part of a lot of community organizations, Rotary, the Chamber of Commerce. I was president of Main Street Martinsburg for several years. And, anywhere I can serve, I like to do it. If I try to say yes as much as I can.
Right.
I've gotten better at saying no sometimes because you can be overwhelmed by it, and you got to remember to focus on the most important things in your life.
Of course.
And, work isn't the be all and end all. That's not who I am. It's what I do.
Right.
And, who I am is a lot different from the day-to-day drudgery of work. But to be honest, it's not drudgery when you love it. If you love what you do, you never work a day in your life.
Of course.
But you got to remember why you're working so hard.
Of course.
And it's for those few little mouths to feed at home that run and jump in your arms when you walk in the door. So.
All right. Well, we're definitely glad to have you in the community, everything that you've done, things that you've done for me personally as a family friend. So definitely appreciate you. Now, for those that may have tax questions or maybe even want to reach out to you for CPA services, where can they find you and how can they contact you?
Well, we're located in downtown Martinsburg at 217 West Burke Street. We're phone number is 304-264-0437. You can just Google Dopson Associates and you'll find us. It's probably not a great time of year to be calling accountants,
right?
But
if
we can help, we will. As we talked before, we primarily focus on small businesses and helping them grow, be in their back office. We have actually a whole system called Your Office.
Okay.
Where we can be your accounting. We do HR work. We do payroll, and it's a whole range. You just basically pick from a menu. What part do you need help with?
Nice.
And so we try to help wherever we can, whenever we can.
Good to know. All right. Well, y'all heard it here first. Ladies and gentlemen, Mr. Steve Dopson with Dopson Associates. Again, thank you for coming through. I appreciate everything you've done for me and things you've done in the community. So, again, if y'all need great tax advice or somebody to help your business grow, definitely reach out to Mr. Steve Dopson. So, thanks again for coming through, man.
Thanks
appreciate
for having me, man.
Yes, sir.
It's been great.
No, it's always a pleasure. Again, thanks for tuning in to Real Estate with Gav. As always, I'm your host, Gav the Realtor. If you need real estate advice or help, you can reach out to me at 304-839-7040, or you can find me at Gav the Realtor on all my social sites. Everybody else, you stay up and stay blessed. Peace.